Welcome back to the SaaS Revolution Show. I'm your host, Alex Theuma, CEO and founder of SaaStock. Delighted to be joined today by Jean-Laurent Pelissier, who is the Managing Director, Head of Enterprise Software at HSBC Innovation Bank. Welcome, Jean-Laurent.
Thanks, Alex. Thanks for having me.
Yeah, good to have you on the podcast for the first time. We met for the first time, actually, just at SaaStock in Dublin, and then I think more specifically, we got to chat at SaaS Society, which is like the founder retreat for those founders over 5 million in revenue, which was at the wonderful Carlton House, and still yearning back for those days. That was a great 2 days. One of my highlights of the year for sure.
Yeah, so agreed. That was a fantastic event. So looking forward to the next one.
Yeah, definitely. We're looking at venues at the moment, and I love this part. It's very exciting. Seeing like where we're going to go. And unfortunately, I don't get to do the recce just to test whether it's the right venue or not. But we do have a colleague that goes out there. So
if they need help, I'll join as well. So.
I know. I put my hand up, but it doesn't work. But anyway, Jean-Laurent. And where are you in the UK at the moment? You don't have the UK accent, but you're...
no, that's right. Yeah. So French name, but grew up in the US in California in Palo Alto. And then I've been in the UK now for the last 13 years, working in the startup ecosystem, so based out of London.
What brought you to the UK? Just like the career? Yeah, tell me.
So initially I came over to do a master's program for a year at the LSE. So I did a master's in finance there. The plan was to go back to the US, and then ultimately, one thing led to another, and ended up staying a lot longer than I thought I would. And now 13 years in, I think I'm here for the long haul. So
okay,
just kind of circumstance.
Yeah. And so we like to start with the deep question about who you are. So we will not buck the trend. So tell us, who is Jean-Laurent Pelissier?
Sure. Yeah. I mean, so as you mentioned, I head up our enterprise software banking division for HSBC Innovation Banking. And so what that means is that myself and my team, we look after all the banking relationships that we have for enterprise software companies that are VC backed between Series A and IPO. So it's a pretty wide spectrum. I would say that the bulk of our companies are probably Series A to C, but obviously our strategy is to work with companies through all life cycles. So, from seed all the way through to corporate. So we do have some, quite a number of large companies as well in the portfolio. Before that, my background is mostly in lending, actually, to startup companies. So I joined Silicon Valley Bank at the time in the UK about 11 years ago. And at the beginning, I was kind of a generalist lender, looking at various verticals like software, hardware, consumer, did some life sciences as well, joined a debt fund for a little while. I left SVB for a period of time as well to join a venture capital fund, which was looking at fintech investments, where I was covering California, and then came back to Silicon Valley Bank in 2018 to head up our late stage lending practice. So again, focused on VC-backed companies, high growth, still loss-making companies, but some of the larger profiles, companies that historically would have been going public, the trend was, companies, and still is, companies staying private for longer. And so we were expanding our product set to try to support those companies from a lending perspective later in their life stage. So did that for 5 years, grew that team. And then earlier this year, transitioned over to head up our software team.
Outside of work, outside of banking, what do you like to do? And maybe what's a fun fact about yourself?
Yeah. So, I mean, I used to do a lot of rock climbing. So that was my thing. And then now I've got 2 young kids. So my ability to rock climb has diminished greatly, but I think they're at an age now where I can get them back into that. So I've been taking my kids over to a local climbing gym, and hopefully I'll be able to do that to the same extent I was doing it, a few years back.
More about lack of time now you've got kids than the risk of it, is it?
Yeah, no, I think it's more the lack of time. I won't be doing anything without any ropes or anything, so everything is pretty safe.
Not free climbing Yosemite or anything like that, and decided not to do that.
Not yet, no.
Not yet.
I'm a banker.
Okay.
I'm risk averse,
Okay. All right. Very good. And so HSBC Innovation Banking is the kind of the rebrand of SVB or HSBC. They acquired the UK and perhaps sort of European entity of SVB. How has that transition been? I guess for you, but and certainly for the business, the SVB is that remain within the business. So tell me a little bit about that.
Well, actually, it's been a pretty smooth journey in the sense that the acquisition had been extremely fast for obvious reasons, but the whole team basically stayed together. I think if we look at the SVB UK company that was acquired by HSBC, we've had very little employee churn overall, which is fantastic. And I think that's a testament to the leadership, the ability to retain the employees, and also the customer base. I think we were able to bring, or HSBC was able to bring, stability to our customers in a very short order, which was fantastic, and that was kind of the number one priority there. Since then, obviously, we've had to work on system changes and that kind of thing. So there was a period of time where we were working quite a bit internally in terms of making sure that everything was kind of set for going back out and growing the portfolio again the way that we were doing it before. But that was naturally going to happen through an acquisition. I think now we're in a position where we're back to BAU. We've got everything set up in a way that will allow us to do the same business that we were doing before, using the same strategy, the same go-to-market strategy, the same customer support strategy, which made us different and allowed us to cater to the VC ecosystem. So yeah, it's been a busy year for sure. But I think if we look at the short to medium term, I think it's actually a net benefit to our clients because we now have a way broader proposition for our customer base. If you go back 2 years ago, SVB historically was a very US-centric institution, which had then launched into the UK. And that was pretty much it from a, international capability. I mean, we had obviously coverage in, other parts in Europe and some teams in China, Canada, et cetera, but nowhere near what HSBC had. And so I think now we have a much broader platform that we can offer to our clients, whether that's, international capabilities or even just local support for companies looking to expand somewhere new, we didn't have before. We also have new divisions like, we have a private banking everywhere pretty much, M&A, advisory. So anyway, the proposition is massive. So I'm really looking forward to how we can leverage that to further support the customers that we were working with and that we want to work with.
This year has been a very difficult year, I think, for all startups, and SaaS has probably seen maybe the first recession. I would say, and certainly in the lifetime of SaaStock's 8 years old, right? I think it's always been boom times. Up until really this year. What are the major factors that are driving that? How do you view this? Are we in a well, I feel like we're in a recession, but what are your viewpoints on that? And how long is this going to last?
Yeah, I mean that's the key question here, right? But I think ultimately the major shift is the fact that 2021, early 22 availability capital was incredibly high, higher than it's ever been before, driven by a lot of new market entrants, a lot of hedge funds coming into the market for growth stage companies. And a lot of that has dried up to a large degree, right? Or at least, people have kind of slowed dramatically in, late 22 and then 23, driven by inflation, higher interest rates, et cetera. So I think that's the major shift that we've seen. And I don't think that's, a big surprise to anybody. I think going forward, I'm cautiously optimistic, right? I still think that there's resilience in the market, right? I mean, I think it's not like the .com period or whatnot, right, where there wasn't a lot of substance behind some of the companies. I mean, here, there's still proper IP, proper companies, proper customers. Yes, the availability capital is more scarce, but there's still great founders, great teams, et cetera. And so I think, the companies are able to refocus on adapting and, having efficient growth and trend to profitability, even if they don't necessarily get there because they don't want to get there yet. I think being able to go back to, the key foundations of, growing a SaaS company, which is having and tracking, key metrics. And if you're able to achieve that and do it well, I think I'm pretty optimistic for these companies doing well in 2024.
And would you say, I mean, you mentioned their highly efficient growth, and we've heard that, I think, obviously a lot, understandably so, this year, sustainable growth, highly efficient growth. Is this going to be the new normal? we are seeing, and I'm seeing a few outlier deals, and certainly from a funding perspective, which are kind of really like eye popping. And I think even I think it was yesterday or the day before, we saw a SaaS company that raised a Series A in sort of like less than 3 months. It was like between 3 to 6 months with potentially very low revenue. And you're like, are we going back to slipping back to the ways of before? I'm sure there are some reasons that I just don't know about as to why that deal was done. But overall, your view on just like sustainable growth is this just going to be like what we're expecting, and for the long while?
I think so, right? I think the outlier was really 2020 to 2022, right? I think that was kind of the outlier period where there was so many macro factors with COVID and everything else that kicked in, that changed really the availability of capital and how companies were being run, where they were really kind of growing for growth at all costs. And I think we kind of lost sight of some of the really key the KPIs that were critical for the SaaS industry. And I think if you rewind 4 years ago, I think generally the market was way more focused on these KPIs and ensuring that companies had strong unit economics. They didn't necessarily need to be profitable, and I don't think profitability is necessarily needed, because these companies need to grow, and the whole idea is to gain market share and create the new category leader. But at least being able to do it in a way where the model is proven, and you can see that it's an efficient business, and there's the capability of being safe, sustainable for the long term if needed. I think that was the case historically. I think that was a bit of a blip, and I think we're kind of back to that now. But I would say that the drop in availability of capital has been remarkable, and so there's still a lot of dry capital around, and I think I would hope that over the next year we're going to see some of that come back into the market, given kind of the stability in the interest rates and inflation going back down a little bit. There's a little bit less volatility in the market. But yeah, I would say we're back to normal essentially.
Yeah, I mean, you mentioned the drop there. I think, I feel this was accurate. I saw some statistic around it's been something like a 70% drop in terms of like companies that are being funded in 2023 versus I think the 2022, which is significant, right? A real shift there. But at the seed stage, at the early stage, we're seeing deals get done, right? We're obviously seeing, and SaaStock brings all the VCs in SaaS, and brings all the founders that are kind of raising. They're getting together, they're having the meetings. Doesn't necessarily obviously translate to deals getting done. But I am seeing seed stage deals getting done, but probably slightly fewer, maybe taking a little bit longer in some instances. At Series A, there was a few deals getting done, but probably less so at B, C, and beyond, right?
Agreed. Yeah. And I think that's just a factor of how that trickles through, right? I mean, the first early like mid 22, I guess the area of the market that was most impacted was the pre-IPO companies, right? Because the public market got impacted, the exit prospects obviously closed, and then that slowly trickles through. And I think seed and A is the most resilient part of the market, just because it's so disconnected from having to rely on an exit event through an IPO. So those valuations are much more resilient. More deals get done at that level. But as you go further up and up, I think that's where you're seeing things tightening. But I'm hoping that'll change over the next year or so.
How can startups? They need capital to survive, right? And obviously, ideally, well, I mean, it depends on who you speak to, but customer funded capital, and is probably the best way, right? But sometimes, especially like SaaS companies, as you reach towards PMF, it can't. It's not always easy. It's not smooth sailing. It's not up and to the right, and hence, and also depending on the ambitions of the company and the founders, then if they want to grow a little bit faster but sustainably, they need to raise money to help fund their ambitions and growth. But given the environment now, and also let's look to forward looking to 2024, how can startups get access to funding? What are the sources of financing currently out there that beyond like I guess traditional venture, but including what are the sources that founders could be looking at if they need capital for their SaaS?
Yeah, and I mean, I think in times where equity is cheap, I think companies end up being fully equity funded. At least the ones where they can raise easily. It just tends to be easier for them to just take a large check at a high valuation and not have to worry too much about the structure, the capital structure essentially. Just talking from a lender's perspective, those markets are more challenging for us, even though it's kind of boom time. Being able to lend to these companies, companies don't really want to spend the time on it because they've just got too much capital to start out with. So, why would they spend the time to work on a debt facility after they just spent time on a fundraising event? So I think in these scenarios, this is where kind of things kind of balance back out, and people are much more cautious about, okay, well, the dilution now is much more expensive, but there's still lending appetite, definitely. So we're still very active on the lending side. Probably looking at deals that we would have wanted to do probably back in 2021 that we just didn't have the opportunity to, given the equity competition out there. So I would encourage founders and boards, and I think they're already doing that, right? Because we're already seeing a lot of inbound, but to consider other sources of capital like debt, and it comes in a lot of different flavors, right? I mean, one of the most straightforward things is venture debt, which I think everybody kind of knows about, but over the last kind of 10 years, there's been other forms such as recurring revenue facilities and stuff that's more use case specific that's coming out. I would also say I think I was surprised actually by the fact that we haven't seen as much M&A this year as I would have imagined. If you'd asked me like 12 months ago, if we had the session, December of 22, I would have said that 23 we would have seen a lot more M&A than we actually have. I think we've seen an uptick, especially at the lower end of companies not being able to raise and, consolidation in the space. I think we're going to see a lot more of that. And I think, equity is one way of funding that, but actually one of the things that we're seeing at the moment are, companies looking for acquisition facilities where they might not have any specific targets in mind, but they know that they're going to be consolidating the market to some degree, or there's going to be some unique ad hoc opportunities coming up, and people are getting ready for that.
So let's sort of dig into maybe venture debt a little bit there, and maybe just explain a little bit more about what that is, and for companies, like who is it for? Because I imagine if you're pre-seed, seed, my thoughts are perhaps venture debt you might not be ready for it. But when are you ready? What is it? When are you ready for it? Why should you take it? As an alternative to venture capital.
Yeah, well, the way that we're structured, and the reason why my team starts to work with companies at the Series A level is that usually that's where these other products become more relevant for companies. So I would say that Series A is kind of the point where venture debt becomes much more widely implemented. Not to say that it wouldn't be done for a company that has a large seed round or whatnot, but that's much rarer. And I would say Series A is more kind of the point where this becomes more of a attractive option for companies. The way to look at it is that it's kind of it's a complement to the equity round that the companies raise instead of a substitution, right? So the idea is they raise from their Series A investors, and they're just trying to kick out the runway as long as they can, so that it gives them more time to be opportunistic with the way that they're spending the capital they have. It could be that they want to aim for specific milestones before the next round of funding, everything to basically try to optimize towards a higher valuation and a better situation when they go out to market and raise. So a lot of what we're seeing right now are companies that have ample runway, probably 12 to 24 months of runway, but they just want to have that extra buffer, extra cushion, so that they can really time the market. They can go out when they feel like they're ready and the market's ready, and they're not forced into a position where they have to fundraise. And I think that's what everybody's trying to avoid, is being forced to go out at a time that just doesn't make sense. So, it's not, I wouldn't look at debt as a bridging kind of solution. I think that's probably where it becomes a little bit more challenging, because essentially the lender then takes equity risk. It's more about, the equity players and the debt provider working together to extend that runway, make sure that everybody's aligned, and take the company towards, the next round of fundraising, whatever they choose to go out for it.
What about if you're a bootstrap company then, and you've got, I don't know, the similar Series A plus sort of like metrics and revenue? Is venture debt also an option?
So venture debt in the way that we define it, probably not, because the way that we define it is, term loan with no financial covenants, right? So it's highly flexible, amortizing over time. And the risk that we're taking, especially at the early stages, is the obviously the company's ability to perform, but also the company's ability to raise future funding. So if the company is bootstrapped, there's definitely debt solutions out there. I wouldn't necessarily call it venture debt, but maybe kind of growth capital of some kind. But it'll be much more structured. What's available there. Usually the lenders that are active in that market will look at putting in financial covenants tied to probably top line growth, maybe liquidity, maybe EBITDA. So the way the debt looks is very different.
What about, I would say, I don't know, I think it was 2022, we kind of saw this birth of the revenue-based financing. I think, there are organizations that have been out there for longer, but it's kind of, it felt like a new entrant and accelerated, and there, all of a sudden, there was all these RBF companies, exhibiting, at SaaStock. What are your thoughts around sort of like RBF and where that is now? And is that something that HSBC, has as a product, and who is it for versus, the other kind of lending forms?
Yeah, I mean, I think it's, we definitely have a version of that. And I think, we kind of started it, probably 13 years ago, in the sense that we were doing recurring revenue facilities for, early stage venture-backed companies. So essentially you're lending a multiple of, monthly recurring revenue. And so it's kind of a revolver. So it's based on a borrowing base. So it's not exactly like venture debt. It's shorter term in nature, right? Venture debt is usually kind of 3 to 5 years term. These revolvers are usually 1 to 3 year terms. So it's a little bit different. The use case is much more aimed towards, working capital financing, financing that marketing spend for that user acquisition or that company acquisition, client acquisition, more so than, being used more like venture debt or equity in terms of, geographical expansions or product expansion, et cetera. So I think the use case is a little different. So I think we've been doing it. I think it just came up in different flavors over the last 24 months. And I think a lot of the solutions are very short term. I think they've got their place in the market, but it is short term. It can be quite expensive. It's, structured differently than what we do. I think we're very focused more on the recurring revenue lines, the way that we've been doing them, as one pillar of what we can offer. But we also have usually combinations of recurring revenue lines and venture debt facilities to cover different use cases.
Makes sense. We're going to move quickly into the quick fire rounds here, Jean-Laurent. So I want to know, what's the best advice that you've ever received?
Yeah, I mean, I would say to keep learning and to not stagnate. I think that's kind of the thing that I try to keep in mind all the time, right? And by that, I mean, when you're faced with a challenging situation, to view it as a learning opportunity as well, and not just, be like, oh, I got to do this now, and it's not really kind of what I want to do. I think everything that we face, whether it's good or bad, but the bad is actually where we learn probably the most, because you're faced with having to deal with situations and taking ownership of that and working through that. And so I think where you stop learning and you feel like, you're not really gaining anything, I think that's where you need to start thinking about, what else you should be doing. But to always put yourself in situations where you learn. And so if I look at, my last, I guess, 10 years working, with startup companies, or 12 years now, I've been looking at making moves even just within SVB, right, to try to, or HSBC Innovation Banking now, but to try to challenge myself. And so I went from being a generalist lender, then I went and headed up our, credit execution team for life sciences, which is a very different sector. Then I went to debt funds, then I went to equity, then I came back, and then I was leading our, late stage lending practice. And then I decided to make a change to challenge myself again to, lead our relationship management team for Enterprise Software. So, they're all kind of lateral changes, right? And most of them within the same institution, but always trying to find ways to improve yourself, and also making sure that, you're using your strengths to add value to, the companies or the clients that you work with.
Yeah, no, I love that. I mean, I often say to, colleagues and new employees at SaaStock, look, if you come in here, give me the best 2 years that you can, within this role, and that's all I can ask for. And then at that point, if you move on somewhere else, whether it's within the business or, kind of elsewhere, I think it's probably the best for you, for your career, but you don't want to be doing the same role, for 4 or 5 years and so on, because I think there will be that stagnation. You're not putting yourself in those positions. So, definitely subscribe to that.
I was just going to add, actually, I think that's one of the things that I really like about the institution that I work for, right? I mean, Silicon Valley Bank and now, HSBC Innovation Banking. it's such a fast growing company, right? When I started back in 2012, we were 40 people. Now we're, roughly 700 people. So it's completely changed. And so those opportunities are always there to move laterally and try different things. So I've always found that, fascinating, just being in an environment. It's kind of like a startup environment to a large degree, right?
Yeah.
Where you're seeing new challenges and new things that you need to kind of come to grips with.
What one thing has moved the dial the most for you in your career?
I think it has to do with, focusing on what you're doing. I think it sounds simple, but I think a lot of the people that I mentor, that I talk to, that are maybe earlier in their journey, they always look at the next step instead of just really focusing on their current step and making sure that they're doing it to the fullest. And so I think maybe this is another answer to your first question, but I think ensuring that whatever role you're in or whatever that you're doing it, you do it to the best of your ability, and that you're learning what you can from that situation and that role before looking really elsewhere. I think as long as you're doing extremely well at the role that you've been tasked with, that you've taken on, people will recognize that, and especially if you're also building your relationships just more broadly, and naturally you'll get new opportunities to do more exciting and different things to leverage the stuff that you've learned and what you've been good at. So I think if I look back at all the jumps that I've made, it's always been in a situation where I'm not really looking for it. It just kind of happens, or it's presented to me because I'm just focused on what I'm doing, and it comes around that way. So yeah, the advice that I always give maybe younger people is to just make sure that they focus on their roles, build relationships in the market and within the organization that they work in, but don't think too far ahead.
Good advice. What's the hardest thing about working in banking?
I think this, the macro environment. I think it's things are always changing, right? And especially over the last 3 years, 4 years, the change has been incredible. I think before that, 10 years prior, since 08, 09, there was a certain level of stability there. Everything was kind of trending up to the right to a large degree. But I think the last 3 years has been a bit of a roller coaster, and so sticking to your guns in that kind of environment and making sure you stick to your values, your approach to the market, etc. when everything is so wild around you, it can be quite challenging. And so people take different approaches. I think one thing that's allowed us to keep doing what we're doing and doing it well over such a long period of time within the venture ecosystem is the fact that through these cycles and through this volatility in the market, we stick to our approach and to what we know works. And that allows us to be a lot more consistent in market, but it's not necessarily always easy.
Do you have a favorite business book that you recommend for startups, or one that you've read yourself, and why that one?
Yeah, I think it's kind of a dated one now, but it's one that I was given by a mentor years ago, which is the Lean Startup by Eric Ries. I thought that was, I think it's widely accepted now in the VC and startup landscape that, it's kind of coined the MVP kind of phrase and everything else, right? But I still think it's really interesting and worth the read for everybody, because ultimately it just describes how, you should really not focus on building something to perfection before you release it, but really kind of go out with, an MVP and then quickly reiterate and iterate on that product by leveraging also what you're getting from your clients, not necessarily what they're telling you, but what you're seeing in, the user activity. And so obviously that has got, direct relevance for enterprise SaaS companies, but just more broadly, right? I think if I look at, what we do within the organization, there's a lot of value that we can provide to companies beyond just, the banking and the debt offering. And it's more about what actually moves the needle. And so, we all have these grand ideas about, how we can support companies, but it's also about allocation of resources and time. And so making sure that, we test, some ideas with certain clients and we see, is it actually valuable or not? And then we can actually, tweak our approach. That's been a key way that we operate.
I know you've touched on this a little bit through the podcast, but I'll ask anyway. So are things going to get better in 2024? And if so, why?
I'm cautiously optimistic. I think it's not going to be dramatically different, but I think, we're seeing stability in interest rates. We're seeing inflation going down. Obviously, growth is, it's very slow. And actually, I think, day or two ago, we saw, contraction in the UK. but I think that's expected, given the rate at which interest rates were increased. But I think that level of stability, the fact that we no longer have these massive jumps in interest rates and inflation being sky high, I think will give people more comfort that they can actually, value companies. Public markets, I would hope would stabilize a bit as well and improve there. There's still a lot of dry capital. We're seeing, a bunch of funds being raised over the last 6 months. There's a lot of funds that were raised before that, that were sitting on a lot of, dry powder. It's gonna be deployed. It's just a matter of time. I think, everybody I speak to in the market, they're saying that, pipelines are picking up. They're seeing more activity. I'm not necessarily seeing that translate into deals being done so far, but I'm cautiously optimistic that we're going to see an uptick, over the next kind of 6 to 9 months. At the same time, though, the other side of the coin is that I would expect we're gonna see some more kind of distressed situations as well, right? A lot of the companies that did raise in 21, usually they raise with, a runway of 2 to 3 years in mind. We're going to come to that. And some of those companies that were funded, don't have the efficiency metrics needed to raise in this kind of environment. And so that's where we're probably going to see, some distressed situations, which would probably lead to that M&A I was referring to earlier.
Yeah. Hop-in was obviously a good example of that, or bad, depending on how you phrase it. Well, Jean-Laurent, we've come to the end of the podcast. Thank you so much for being a great guest. If people want to reach out to you online, connect, ask any questions, what's the best way to do so?
LinkedIn is probably the best way. Send me a message on there, or my email address, which I don't know how we can share that easily but it's basically just my name at hsbc.com. So that's probably the two best ways.
Awesome, good stuff. Well, thank you so much for coming on the SaaS Revolution Show today. Good to see you again. Wishing you a great Christmas and New Year, and for some great things in 2024 for yourself, HSBC, and the SaaS market in general.
That's great. No, thanks, Alex. Thanks for having me.